Let's be honest, when tax season rolls around, most of us just want to get it over with. We plug our numbers into the software, take the standard deduction, and hit submit, hoping we didn't make a mistake. But what if I told you that in that rush to finish, you're almost certainly leaving money on the table, sometimes thousands of dollars? The IRS tax code is filled with perfectly legal, ethical, and often simple ways to reduce your tax bill, but they aren't always advertised. The software will only ask you about them if you go looking, and many people simply don't know what to look for. This isn't about fancy loopholes for the wealthy. This is about legitimate deductions and credits that are available to teachers, parents, students, homeowners, and even employees who have to buy their own work supplies. Today, we're pulling back the curtain. This is your guide to the most commonly missed tax deductions and credits that can put serious money back in your pocket, legally and safely. First, we have to get one thing crystal clear, because this is the foundation of all tax savings. What is the difference between a tax deduction and a tax credit? A tax deduction reduces your taxable income. Think of it as taking a chunk off the top of your income pile before the IRS calculates how much tax you want it. If you're in the 22% tax bracket, a $1,000 deduction saves you $220 in tax. It's valuable, but its value depends on your tax bracket. A tax credit, however, is a $4 reduction of your actual tax bill. A $1,000 tax credit saves you $1,000, period. It's infinitely more powerful. So, while you should pursue every deduction you're entitled to, you should be absolutely relentless in hunting for every single tax credit you might qualify for. That is where the real gold is hidden. Let's start with a credit that is massively underutilized, often because people don't think they qualify. It's called the Saver's Credit, or formally, the Retirement Savings Contributions Credit. This isn't a deduction for your retirement contribution, it's a direct credit against your tax for making that contribution. If you're a low to moderate income worker, and you put money into a retirement account like an IRA or your employer's 401k, the government will actually pay you to save. The credit can be worth up to 50% of your contribution, with a maximum credit of $1,000 for individuals and $2,000 for married couples. The income limits are the key here, and they are higher than many people realize. For a single person, you can qualify with an income well into the $30,000 range. This is free money on the table for being responsible with your future, and it's one of the best deals in the entire tax code. Now, let's talk about education, because there are two key benefits here that people mess up all the time. First, the student loan interest deduction. You can deduct up to $2,500 in student loan interest you paid during the year. But here's the twist that most people miss: it doesn't matter who actually made the payment. If your parents are generous enough to be making payments on your student loan, the IRS treats that money as if it were given to you, and you then paid the interest. As long as you are not claimed as a dependent on their return, you can deduct that student loan interest on your own tax return, lowering your tax bill even though you didn't spend a dime of your own money. The other education benefit is the lifetime learning credit. Unlike the American Opportunity Tax Credit, which is only for the first 4 years of college, the lifetime learning credit can be used for any post-secondary education, including graduate courses and even courses to acquire or improve job skills. It's worth up to $2,000 per tax return, and it's a credit, not a deduction, making it extremely valuable. Shifting gears to work-related expenses, a huge area of confusion is the home office deduction. You've probably heard that it's a red flag for an audit, and it can be if you abuse it. But if you qualify, you should absolutely claim it. The key is that the space must be used regularly and exclusively for your business or trade. If you're an employee working remotely, the Tax Cuts and Jobs Act suspended this deduction until 2025. However, if you are self-employed, even as a side gig, you still qualify. You have two methods: the simplified method, which is a standard $5 deduction per square foot of your office up to 300 square feet, or the regular method, where you calculate the actual percentage of your home expenses like mortgage, interest, rent, utilities, and insurance that are attributable to the office space. for those with a dedicated, legitimate office and high home expenses. The regular method can yield a much larger deduction. Another category of often missed deductions revolves around what you might consider miscellaneous costs. Let's talk about medical expenses. You can only deduct medical and dental expenses that exceed 7.5% of your adjusted gross income, which is a high bar. But if you have a year with significant medical costs, you need to know what counts. It's not just doctor bills and prescriptions. It includes things you might not consider, like mileage driven to and from medical appointments at a standard rate per mile. The cost of a weight loss program if it is prescribed by a doctor to treat a specific disease like obesity or hypertension, and even certain home improvements for medical care. If you install a ramp, widen doorways for a wheelchair, or add handrails in the bathroom on a doctor's orders, the cost of those improvements minus any increase they cause to your home's value can be included in your medical expense deduction. Then there are state and local taxes. Most people who itemize deduct their state income tax. But you have an option. You can choose to deduct state and local income taxes or state and local sales taxes. If you live in a state with no income tax, like Texas, Florida, or Washington, you automatically deduct your sales tax. But even if you live in a state with an income tax, you might be better off deducting sales tax if you made a major purchase during the year. Did you buy a new car, a boat, or an expensive piece of equipment? The IRS has a calculator that allows you to figure out your potential sales tax deduction based on your income and the general sales tax rate for your area. Plus, you get to add the sales tax you paid on those specific major purchases. For someone buying a $50,000 car in a state with a 6% sales tax, that's an extra $3,000 in deductible sales tax right there, which could easily make it the better option than deducting your state income tax. A final pro tip involves charitable contributions. Everyone knows you can deduct cash donations to qualified charities if you itemize. But you can also deduct the fair market value of donated goods, like old clothes and furniture. The real secret is deducting your volunteer expenses. If you volunteer for a qualified organization, you can't deduct the value of your time, but you can deduct your reimbursed out-of-pocket expenses. This includes the standard mileage rate for any driving you do for the charity, the cost of uniforms you have to wear, and even the cost of ingredients you buy to make food for a charity event. Keep a log and save your receipts. These small amounts can add up to a meaningful deduction. It is crucial to understand that this information is for educational purposes, and I am not a licensed tax professional. Tax law is complex and changes frequently. The strategies discussed are perfectly legal, but you must meet the specific qualification criteria and maintain proper documentation in case of an audit. The goal is to pay every dollar you legally owe, and not a single dollar more. By being aware of these often overlooked deductions and credits, from the saver's credit to the sales tax deduction, you shift from being a passive taxpayer to an active manager of your own finances. So, before you file next time, take an extra hour. Research these items, see which ones apply to your life, and make sure you're claiming every single benefit you've earned. It's the smartest hour you'll spend all year. If this guide helped you uncover potential savings, please support the channel by liking this video and subscribing for more content that helps you keep more of your hard-earned money.